All right, good morning and welcome to our stock market introduction. I'm excited to talk about this with you today. And today we're going to talk about types of business entities, what kind of businesses there are out there. So, to do that, we're going to today identify forms of business organizations. We're going to primarily talk about sole proprietorship, partnership, and corporation. And we're going to talk about their limitations and rewards associated with each. Now, I also threw in there what an LLC is because that has become a really popular type of business entity in the United States. And so we'll just briefly touch on that when we get to that slide. So what is a company? A company is a business or association usually formed to manufacture or supply products or services for a profit. If you go into business, you want to make a profit. You're not there because you want to lose money. And they manufacture and supply something. And they can be a sole proprietorship, a partnership, or a corporation. A company can be any of those things. So let's talk just a minute about a sole proprietorship. It's a company owned and run by one individual who receives its profits or bears its losses. A proprietorship is not separate from its owner, who, on the bad side, is liable for all company debts. Now, there are some benefits and disadvantages to this. One of the benefits is you own it. It's yours, both gains and losses. It is easy to set up and run because there's no fees and there's no required filing with the state. Other than if you are a business that is selling something, you will have to collect sales tax and you need to file a sales tax form with the state for that. The disadvantage, or the main disadvantage of a sole proprietorship, is that the liability rests solely with you, the owner. If you, as the owner, are in debt and something happened and you owe $30,000, it is your debt as the person, not just the business's debt. If you can't pay it, creditors can come after your home, any money that you might have as payment for what you owe them, because the liability rests solely on you, the owner. Now, overwhelmingly, most businesses are sole proprietorships. If you think about your community, I want you to kind of think in your head what businesses would be like a mom and pop type stores that are run by one person. Think about the kinds of things that are in your community that are run by them. So a sole proprietorship is an easy way to get into business and run something. I ran a business for a little while, sole proprietorship, and I had a business where I produced something and I shipped it and sold it online. And so that is something that you can do. Now, after a while, it didn't make sense for me to continue that sole proprietorship, and I closed that business. Because I wasn't making a profit. It's hard to motivate yourself when you're not making a profit. But there's other businesses that do make profits and have done well. Partnership is the second one. It's a company owned and managed by two or more people who share its profits or losses, and a partnership is not separate from its owners. They are also liable for the company's debts. Now, there are benefits. It's a shared business. You've got someone to bounce ideas off of. There's more people to work the business. There's no fees. There's flexible management because there's just two of you, or maybe there's four of you. My husband and his brothers have a business that they run. The disadvantage is that the liability of business rests on the partners. So in my scenario of sole proprietorship where you had $30,000 that you owed, in this case, the liability rests on the partners. There's more people that $30,000 could be distributed over. If there were two of you, you might each owe $15,000 if you split the business 50-50. However, In a partnership, you should have some kind of founders or partnership agreement, because partnerships tend to have disagreements. And when they do, it's like, well, what happens to the business? If we don't get along anymore, does one partner get to buy out the other one? Or do we have to sell the business? What is the agreement before we even go into this? And this just helps to manage the business and help and hope that there's no hard feelings, because it can get bitter when there's money that's owed and it's stressful. So thinking about that. Okay, the limited liability corporation, or an LLC, I just wanted to throw it in here really quickly. And this is a business structure in the United States whereby the owners are not personally liable for the company's debts or liabilities. But it is more similar to a sole proprietorship and partnership than a corporation. It does have limited liability. It's kind of a hybrid that combined the characteristics of a corporation with those of a partnership or a sole proprietorship. So a limited liability corporation means that it is set up, there is the disadvantages, and I didn't put this on here, but the disadvantages is that there is paperwork involved. You do have to hire someone to help you set this up. Usually you hire a lawyer or someone to help you set this up so that you can file the paperwork. There's an operating agreement required, there's state filing, there's fees, but it is fairly low maintenance. It is not as much paperwork as a corporation requires. It can be either a sole ownership or a partnership. So my husband and his brothers have an LLC. When his dad passed away, all the farmland went into the LLC, and the brothers run that company together. But they don't have personal liability. If something goes wrong, the only thing that they could lose would be the land. They wouldn't come after their houses or their cars. So you're only liable as far as the business items are pertained to, and your personal finances are not included in that equation. So it can be an alternative to a sole proprietorship or partnership by limiting liability. But there is paperwork you have to do, and there are some fees that you have to pay up front to get there. All right, a corporation, the big one. This is what we're going to primarily be talking about when we're doing the stock market game. But it's a company legally separate from stockholders who own it and managers who run it. So, benefits. There is limited liability. There is an influx of money to spend. It can become bigger than itself. If the owner dies, the business doesn't die. The corporation is an entity in and of itself. It will keep going even after the owner dies. The disadvantage is that the profits are not yours. You're sharing them with your stockholders, and it is difficult to set up. Most require state filings, and they have high fees involved. It does have to have a board of directors that run the corporation. Now, if I were a sole proprietorship and I wanted to change something really quickly, I could do that because it's my business and I can do what I want. But in a corporation, things probably don't flow quite that quickly because it is overseen by a board of directors and a CEO, and the CEO is held accountable by that board of directors and the stockholders who vote. They hold a vote as to who is going to run that company on the board of directors. And so a corporation has shares of stock. Now there's two different kinds of corporations, and I'm just going to tell you about each one quickly. A private corporation, they actually don't sell shares to the public. You can't buy shares of a private company. You can be a corporation and not let other people buy your shares. Like you have bought them all yourself. So my sister and her husband run a farm, and on their farm, there's his dad and himself and his brother, and they own all the shares in that corporation that they run. I can't go buy shares in their farm. It's not available to me. It is a private corporation. However, On the other side, a public corporation, the stock of a public company is owned and traded by individual and institutional investors. In contrast, the stock is held by company founders, employees, and sometimes venture capitalists. Now, a lot of times when there is a stock offering, company founders like to try and keep a large portion of the stock for themselves so they can have a majority control. Because remember, each stock is a vote in that company. So if I have more stock in the company, then I have more votes in the company. A lot of times, employees will be offered shares of stock in their company as by working there. They'll say, you can have, as part of you, you're going to be part of the ownership of this company, and we're going to give you stock so that you can be part of this, and that's a benefit of their employment there. And then there's also venture capitalists who invest large sums of money because they see something that's going to happen, or they see something in the future. Now, if you look at this page, you'll see that I have 3 pictures at the top. And each one of those represents a different business. Now, I did not put an LLC on here, Limited Liability Corporation, but one of those pictures is a sole proprietorship, one of those pictures is a partnership, and one of those pictures is a corporation. Now, I'm going to give you just a couple of minutes to look at that and decide, which one's which. So as I look at that, I can see the first picture is of a salon where hair gets cut. And if you thought that that was the sole proprietorship, you would be correct. Most salons are run. I'm not saying there aren't salons that are part of a corporation, but a lot of the mom and pop ones that you go to and get your hair cut at, they're just run by an individual and they're a sole proprietorship. Some of them own the business and then they rent out booths to other people, so there might be other people working in there, but they own the business. Partnership. If you picked Ben & Jerry's, then you would be correct. The 2 men went into business together and they created ice cream that has become a household name. And the corporation, last, is Coca-Cola, one of the biggest, I think it's the largest beverage industry in the United States, and they have all different kinds of products besides just Coca-Cola that they supply. And that is a company that you can actually own and buy stock in. Now, what I want you to do is I want you to click on the Padlet link, and we're going to bring this up here. And in this Padlet, what I want you to do is I want you to click on the plus button, and there's a little pencil there, and it's going to click up, and I've already added mine to the Padlet. So you can click on and type in your name so I know who you are. And then you're going to give me an example of a sole proprietorship, a partnership, and a corporation. Okay, and so I've kind of listed some things there. I know Quality Automotive in my town is something that is a small business that fixes cars. I know the owner. Ben & Jerry's ice cream was the partnership example I gave. And then for the corporation, I put Hershey's on here. So we're going to let everybody have a few minutes to kind of put those on there. We're going to see them pop up. And as they pop up, we can discuss some of those. How do you know that that's a corporation or a partnership? And sometimes you have to do some research. Partnerships are probably the hardest to know because we don't always know right off the bat. But give me an example of each one. Okay. So we'll look back at that Padlet a little bit later. I'm going to continue on talking about our stock market, which is our unit that we're starting. And it's a place where shares of publicly listed companies are traded. There's several different markets available. They're not all in the same market. People invest in companies by buying stock. The stockholder is given ownership in the company and given the right to vote and receive dividends when the company produces a profit. As a stockholder, your liability is limited to your investment. Now, if I'm talking about vocabulary words and you're like, whoa, I don't know what that means, that's okay, because some of these we're going to talk about in more detail tomorrow and kind of go over those definitions. So, but what I want you to do today is we're thinking ahead. The stock market game is what we're going to be kind of playing, my version of it. So if you had, I need you to be thinking, $100,000 to invest, what would you invest in? What company would you take that money in to make you a profit? So think, if I had $100 and I invested it in a company and I bought 10 shares at $10 a piece, what company is going to take that from $10 a share to like $20 a share and make my investment go from $100 to $200? What companies are performing well? So think about that, and I want you to create and research a list of companies you feel would be a good investment and why you chose that company. What's your reasoning behind that choice? And then I want you to share that document with me. Now, there's lots of places you can look online, and I don't want you to just think about big companies, because I know that when we think of companies, we tend to think of things that are right in front of us that we use all the time, like Walmart, or maybe a sports brand like Adidas. And so we think about those big companies, but there's lots of smaller companies out there, or tech companies, or companies that have been innovative that aren't necessarily a household name and might be a good investment. So you might do some research on the internet as to companies that are performing well in the stock market, or companies that have a future, and see if they are a traded company. And you're going to create your list. And maybe you come up with a list of 10 companies that you think might be a good investment. Doesn't mean they are, but you think they might be a good investment, and why you think they might be a good investment. And then I want you to share that document with me. We're going to use this document in the future because I'm going to divide you into groups, and as a group, you are going to decide what you're going to invest your money in. And we are going to follow those investments over a period of time to see how they do. And during that time, we're going to learn how to read stock, like when you look in the newspaper or you look online and you see what stocks are. What does it mean that the stock came down a point? What does it mean that it was up 3/8? So all of those things, like how to read a stock, we're going to talk about that and look at it so that you understand how to do that. Because investing and understanding it is the key to making good use of your money. Now, the stock market's not the only thing you can invest in. You can invest in bonds. You can invest in real estate. Many people that don't want to invest in the stock market on their own use what we call mutual funds, which is another thing that we will look at. So today, look up some different companies, research them, some that you feel would be a good investment and your reasoning behind your choice. And later this week, we'll get into groups and put together a set of companies that we're just going to track for a while. And to make it interesting, we're probably going to have a contest to see which group can pick the better stocks and make the most money. So I will talk to you tomorrow, and have a good day. Oh, one more thing. If you had never heard these vocabulary words before and we're still struggling, you have a video that you could watch. She does a good job of explaining things using the story of the 4 little pigs instead of the 3 little pigs. It's called The Choice of Business Entities, and she talks about each one a little bit and kind of gives you a good idea of what each one of those are. And if you need any of my resources, they are listed here that I used for today's lesson.